Walk me through the role that short sellers have played during this process and how much pain there has been felt.
This is GameStop from a couple of years ago, and it's happening again with the meme stocks with Bed Bath & Beyond leading the troika right now with AMC and GameStop also in the mix. Shorts were down $1.5 billion in August already in mark-to-market losses. Today, they've gotten back $500 million of the loss. So, they're active. We're seeing short covering and the short squeeze in AMC and GME. But Bed Bath & Beyond is interesting because all the short squeeze we've seen have been replaced with new short sellers who basically have jumped in at $5, $10, $15 because they saw it attractive to short the stock at those levels.
But Ihor, isn't short interest like totally different than it was, a year and a half ago?
Yeah, what we've seen is short interest was declining overall in the market. Recently, we've seen an uptick as the big short sellers, the hedge funds, are putting back their positions because they've missed a bunch of the rallies. So they're starting to increase their shorts, increase their long positions. But in these meme stocks, we're seeing $2 billion worth of short interest in both AMC and GME, and up to $800 million of short interest in Bed Bath & Beyond. Big plays on the short side.
So in terms of current positioning, how would you describe it? Is this as the market has evolved, as you say, new shorts have come in. How different are those shorts to the ones that were previously there, and how much staying power do they have in terms of the volatility that we're seeing?
Well, the big difference is that the old shorts are bloodied and had to exit their trades, kind of like trench warfare. The first set of soldiers took a beating and then were replaced by the next set. What we saw in Bed Bath & Beyond were shorts that took huge losses, and at $5, $10, $15 a share, they started getting out. What we saw was that every stock borrow that was returned, there was a new short willing to get in at $15 because they thought that BBBY was overpriced. In GameStop and AMC, we're actually seeing the short squeeze take shorts out of the market over the past month to the tune of 5 million shares between AMC and GameStop.
How much more is that to shift? So how much more short covering do you think we're going to need to see, and the shorts get squeezed out? And when do you think we kind of level out? I'm just trying to get a sense of how much that can actually lead the rally.
This is really a long buying rally more than anything else. You had a large amount of short covering in GameStop and AMC, but it's a small piece of what the daily trading volume is. I don't think you're going to see that much more short covering in the near future in AMC and GameStop because there's a little bit of a retracement in price. Bed Bath & Beyond, I think there is going to be some short covering and a short squeeze in the name.
If I want to borrow stock, how much availability is there, and how much is it going to cost me?
Yeah, and these three names, the stock bar market is really, really tight. All three names have over 90% utilization. There's just not much stock left to borrow to cover new short sales. So really, we're seeing replacements. Short gets out, new short gets in using that same borrow. Bed Bath & Beyond has gone crazy. We've seen rates on existing shorts of 12 to 20%. New stock borrows are going at 80% and above.
Wow.
So it's going to be really, really expensive to borrow this stock.
Traditionally, because you guys look at predictive analytics, what does this tell us then about what hedge funds need to do towards the end of the year to chase performance as the short selling kind of really gets squeezed?
Well, what we're seeing is overall in the market, short selling we've seen some short covering in the market because the value of the shorts have gone up. So just since the market highs on June 16th, we've seen $170 billion worth of mark-to-market increase on the short side, which is offset by $45 billion worth of short selling. So the value of the total short book has gone up, even though we've seen short covering in the market. And I think that what's happening is the hedge funds are getting in, they're getting more exposure on both the long and short side because they need to make up the performance they missed in the last couple of weeks.
What I find interesting, at the same time, we are seeing it is incredibly cheap to hedge right now. How are the shorts using options as well to protect their positions? What is the overall picture?
Well, you're seeing option trading in a lot of these names just because it's an easy way to get leverage on the long side and the short side. What we're seeing is a lot of option plays that we saw in Bed Bath & Beyond, in GameStop, AMC. Um, but again, everything's being delta hedged. So if you're hedging if you're a market maker, you sold an option, you're offsetting that trade in the equity market. So anyone who's long an option, there's an offsetting short in the market to kind of make the market maker flat. So that activity is actually the option activity is translating into the short and long part of the market due to the delta hedging of the stocks.